In a partially amortized loan with a balloon payment, when the balloon becomes due, what is the usual course of action? So today we're jumping into the finance section and we're going to talk about amortization. So just as a review, an amortized loan in most cases is when the payment stays the same. So the payment is going to stay the same, but a portion of that payment, some of it goes towards interest and some of it goes towards principal. Now, in a partially amortized loan, what that means is the payment's going to stay the same. So we may have an amortization for 30 years, right? So a 30-year mortgage where the payment stays the same every single month for 30 years. Partially amortized basically means that we set the payment for 30 years, but at some point that whole thing's going to come due well before that 30 years rather. So it's calculated on an amortization schedule, and the benefit is of an amortized loan or a partially amortized loan is to keep that note as low as possible. But as I said, the rest of the balance, even though it's set on a 30-year schedule, the loan doesn't last for 30 years. Let's say that it lasts for 5 years. So what happens is I'm going to pay the exact same amount, all right? Some of it goes to principal, some of it goes to interest. Under a fully amortized, I'd pay the same for 30 years. But on a partially amortized, the payment is if it's 30 years, but I'm only going to pay it for 5. So what happens after 5 years? Well, after 5 years, the remaining balance is going to be due. So at a certain point in time in the future, that remaining balance is going to be due. So I'm going to have a consistent payment for 5 years, and then in 5 years, they're going to say, Brent, we need the rest of the money. That is called a balloon payment. So a partially amortized loan with a balloon means that to keep the payment low, we amortize it over 30 years, but the loan doesn't last for 30 years. The loan lasts for 5, and after 5 years, that balloon is going to come due. Now, what typically happens when the balloon becomes due? Generally speaking, we just refinance. So we negotiate a rate with the bank, and we're just going to roll that baby over, take that remaining balance, and then roll it over into another of the loan. So let's take a look at our question. The question says, in a partially amortized loan with a balloon payment, which is what we just discussed, when the balloon becomes due, what's the usual course of action? All right, A says the lender automatically forgives the remaining balance. That's not true. B says the loan is extended for the loan for another period or a rollover. That's typically what's going to happen. C, the loan converts to a fixed rate mortgage with new underwriting, without new underwriting. That's not true. It doesn't automatically do that, but we could, but it doesn't automatically do that. The property enters into foreclosure proceedings. So no, we don't do that. So your answer is going to be B. The loan is essentially rolled over or is extended for another period.